Let's just take a look at how the Kenyan shilling is faring today, because it's pretty much holding steady against the dollar today, with the traders saying it could firm in coming sessions as commercial banks showed signs of unwinding long dollar positions. Let's take a look at whether that really is the case in light of what we're seeing with dollar strength globally right now. Grace Makoko, Head of Financial Markets East Africa at Standard Chartered, joining us on the line. Grace, thanks for joining us. So we've seen the shilling at lows or new lows for this year, and trading all the way up beyond 86 to the US dollar. It's come back slightly below that. But what are your views right now on some of the key factors that are driving recent shilling weakness?
A couple of things. The first would be just after the budget. Following the elections and then the budget also being read, we expected inventories to start being stocked up by the different traders, and generally the trade and commerce to pick up. So this was expected. The current weakness was expected. I think it coincided with all the statements made by the Fed on the quantitative easing. That looks more like a coincidence rather than the driver of the current shilling weakness. We had seen shilling weakness at the end of May on the back of dividend payments. A lot of the companies that are listed on the stock exchange, particularly the banks, needed to declare dividends, and we saw that weakness, which is expected. It's part of the cycle. And then on the back of that, once the budget was read, inventories being stocked up. And I think then you have the Fed, Bernanke's comments also being factored in, but I wouldn't say that's the major driver of the current weakness that we see. And we've also seen CBK being consistent in how they treat developments in the foreign exchange market. Because the depreciation has been gradual and it has been orderly and it has been fairly predictable, CBK has kept out largely from the market, and they're just looking at developments. So we expect, as in the last days we've seen 86, maybe the top side 86.20. We expect that to continue. Tops we'll see probably is 86.50. Should there be any spikes in demand, which we don't expect, maybe we could touch 87, but that is unlikely.
What I do find... Sorry, Grace, continue.
I'm saying, should the currencies continue to behave like this, then we would actually expect CBK to come in and start to buy dollars, the way they've been doing whenever we've seen inflows, left-hand side inflows, really mostly from participants in the stock exchange, offshore investors coming into the stock exchange. That's when we see those inflows, central bank come in and start to buy.
Yeah, what I do find interesting, Grace, if I could just touch on the bond auction today as well, because that has also been an interesting dynamic. Of course, we've seen bond yields which had started to tick up, but today's bond auction encouraging. 10-year yields tracking lower to 12.371%, and then 5-year yields tracking lower as well to 11.305%. So do you see the strength that we saw coming through today being sustained?
I would say for the bond auction, we don't have that much participation from offshore investors in bond auctions. So bond auctions is really local participants, fund managers and banks. That rates that we've seen coming out in the auction are what was expected really in the market on the back of the developments last week in the one-year Treasury bill. So that's not out of sync or out of character in terms of what we've seen on the bond market. But you have completely different participants in your fixed income compared to the equities. So there is no real strong correlation with what's happening outside Kenya in the international markets.